Today's market move wasn't just the pullback after recent gains. It reflected a deeper shift in how investors are thinking about inflation, growth, and whether policy support may stay out of reach longer than many had hoped. U.S. stocks closed lower across the board. The S&P 500 fell around 0.2%. The Dow dropped a similar amount, and the Nasdaq was relatively more resilient but still finished in the red. Under the surface, though, the bigger story was not equities. It was the sharp rise in Treasury yields, the surge in oil, and renewed stress in volatility markets. The U.S. 10-year yield jumped meaningfully higher. Oil rose more than 4%. The VIX moved back up, and sectors that depend heavily on lower rates, especially real estate and utilities, were among the weakest parts of the market. So, what changed? The key shift was a sudden return of inflation anxiety, triggered by renewed concern over global energy supply. Reports of disruption to a major Middle East oil transit route pushed crude sharply higher. Markets immediately began reassessing the idea that energy pressures had been fading. That matters because higher oil prices don't stay isolated in the commodity market. They ripple through transportation, manufacturing, logistics, and consumer costs. Investors know that if energy rises again, central banks may have less room to ease policy. At the same time, reports pointing to persistent wage pressure in the services economy added another layer of concern. In simple terms, investors were forced to confront two inflation risks at once: rising energy costs and sticky labor costs. That combination changed expectations quickly. Instead of asking when rate cuts might begin, markets shifted toward asking whether rates may need to stay restrictive for longer. That helps explain why bond yields rose so sharply and why rate-sensitive sectors sold off. Capital flows also told an important story. Money moved decisively into energy, which was the strongest sector of the day. Financials also showed some relative strength, likely because higher yields can support bank lending margins in the short term. But elsewhere, flows were defensive in a different sense. Investors were not simply rotating from one growth area into another. In several areas, they appeared to be reducing exposure broadly. Even gold fell sharply, which is notable. When both equities and gold struggle on the same day, it can sometimes suggest investors are raising cash or reducing leverage rather than expressing a clean macro view. That's where the hidden fragility may be building. Much of the recent market strength has depended on a relatively small group of mega-cap growth names carrying index performance. When yields rise quickly, those high-valuation leaders can become more vulnerable. If institutions begin using those liquid positions as a source of cash, market leadership can narrow further or even crack. One open question investors are debating right now is whether today was simply a one-day inflation scare or the start of a broader repricing around higher for longer rates. I'd be interested to hear how you see that risk developing. The broader macro signal from today's session is that markets remain highly sensitive to any challenge to the soft landing narrative. For months, the constructive view has been that inflation would gradually cool, growth would slow gently, and central banks could eventually ease without major damage. Today reminded investors that this path is not guaranteed. If energy re-accelerates while wage pressures remain firm, policymakers face a harder trade-off. Support growth too early and inflation risks return. Stay restrictive too long and growth weakens further. Looking ahead, markets will be watching several things closely: oil price stability, incoming inflation data, labor market softness or resilience, and commentary from central banks. Earnings also matter now, because companies will need to show they can protect margins if input costs rise again. What this suggests for investors is that the market is moving from optimism towards selectivity. Not all companies perform the same in a world of higher yields and higher costs. Balance sheet strength, pricing power, and real cash generation may matter more than simple momentum. If you enjoy this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. Thank you for spending a few minutes here today. I appreciate you being part of the channel.